If you have been scrolling through financial news lately, you have probably seen a lot of conflicting advice. One expert tells you to wait for the rates to drop further, while another warns that refinancing resets your mortgage clock to zero. It is easy to feel paralyzed by the options. At My Team Inc., we believe in looking at the math, not the myths. The question isn't whether refinancing is bad or good, it's whether it works for your specific financial goals in 2026. If you could save $250 or more every single month, that is $3,000 a year back in your pocket. But before you sign on the dotted line, you need to understand the mechanics of the deal. What is a mortgage refinance? In the simplest terms, a refinance is when you replace your current mortgage with a new one. This new loan pays off the old one, and you start fresh with a new interest rate, a new monthly payment, and potentially a new loan term, like switching from a 30-year to a 15-year. People typically refinance for three reasons. The 250 rule: is the math in your favor? A $250 monthly saving sounds fantastic, but refinancing isn't free. You will encounter closing costs, which typically range from 2% to 5% of your loan amount. To decide if a refinance is a win, you must calculate your break-even point. How to calculate your break-even point? This is the moment when your monthly savings have officially paid back the cost of getting the new loan. Use this simple formula. U20. Example A. If your closing costs are $6,000 and you save $250 a month, $6,000, $250, 24 months, 2 years. Example B. If your closing costs are $10,000 and you save $250 a month, $10,000, $250, you are 40 months, 3.3 years. The consultant's take. If you plan on staying in your home for 5 to 10 years, a 2-year break-even point is an absolute home run. However, if you are planning to sell the house in the next 18 months, you would actually lose money by refinancing, because you wouldn't reach the break-even point before moving. When is refinancing a bad idea? We are professional consultants first and mortgage brokers second. Sometimes we tell clients not to refinance. Here are the scenarios where it might be a mistake. If you are 12 years into a 30-year mortgage and you refinance into a new 30-year mortgage just to save a few dollars a month, you are extending your debt by another 12 years. Even if the rate is lower, you might end up paying significantly more in total interest over the life of the loan. The solution: ask us about a 15-year or 20-year term to keep your payoff date on track. Historically, the 1% rule suggested you should only refinance if you could drop your rate by a full percent. In 2026, with higher home balances, even a 0.5% or 0.75% drop can result in massive savings. If the drop is less than 0.5%, the closing costs often outweigh the benefits. If a lender is charging excessive points or fees that push your break-even point past 4 or 5 years, it becomes a risky bet. Markets change, and you don't want to be underwater on your refinance costs for half a decade. Why 2026 is a unique year for homeowners. As we move through May 2026, the mortgage market has stabilized after the volatility of previous years. Rates are drifting in the 6% range, and for many who bought when rates spiked, there is a window of opportunity to lock in a lower payment. At My Team Inc., we specialize in analyzing the current market to see if you are overpaying. Many homeowners are still paying private mortgage insurance, PMI, simply because they haven't checked their home's appreciation lately. Refinancing can often eliminate PMI, adding even more to that $250 monthly saving. The My Team checklist. Are you ready? Feature 1, credit score. Check. Is your FICO score higher now than when you first bought the home? A better score equals a better rate. Feature 2, equity check. Do you have at least 20% equity in your home? This helps you avoid PMI and get the best terms. Feature 3, the mortgage coupon. Test. Locate your most recent mortgage statement. We call it the mortgage coupon. Check your current interest rate and your remaining balance. Feature 4, the 5-year plan. Do you see yourself living in this house in 2031? If yes, the long-term math usually favors a refinance. How we can help you analyze the numbers. Most lenders just want to sell you a loan. We want to provide a financial analysis. If you send us a copy of your current mortgage coupon, we can run a free, no-obligation comparison for you. This analysis shows you refinancing isn't bad, it's a tool. When used correctly, it can fund a college education, pay off high-interest credit card debt, or simply give you the breathing room you need in your monthly budget. Final thoughts. Don't let analysis paralysis keep you from saving thousands of dollars. The truth is that for many California homeowners, saving $250 a month is a conservative estimate. Are you curious about what your new payment could look like? Contact Roni Velasquez and Mona Botros at Maya Team Inc. today. We are here to help you navigate the rules of buyer and seller representation, trust and probate guidance, and of course, finding the perfect mortgage solution for your family. Contact us